Hey guys, today we'll be going through an update of the housing market in Australia as of February 2024. We'll go through each capital city one by one, its current performance, its likely future performance. We'll go through national trends to show leading indicators of what may happen to the Australian property market. We'll show the lending environment, what interest rate you should be getting. So many different things, 20 charts to give you a quick deep dive and immersion so you can get abreast of what's going on right now. It was W. Edwards Demings who said, without data, you're just another person with an opinion. Okay, so we'll be sharing data so we can know that we're making unbiased decisions. Let's go. My name's Peek and I help people build passive income through the Property Investment Accelerator using data without needing a $15,000 buyer's agent every single time. In this channel, we talk about property, the economy, and financial happiness. Hit the subscribe button, give it a like, turn the notification bell on. Thank you for being with me. Let's go. The first slide, and this is all from CoreLogic, shows the residential real estate wealth quantum in Australia. $10.3 trillion is what the Australian residential real estate sector is worth. Now, I want you to understand that of this, the amount of debt is just 2.2 trillion, okay? That means that there is only 19.8% LVR on the Australian residential market. That's like saying if you have a property worth $1 million, you have less than $200,000 of mortgage or debt in it. That's on average across Australia. So, suffice to say, it's a very strong and resilient and low debt environment. And that's why the interest rate rises haven't meant distressed sales, foreclosures, 3-month dwelling price changes. Overall, in the last 3 months, Australian housing has gone up 1%. Regional areas have gone up more than that, 1.2%, and capital cities have gone up 1%. You can see regional Tasmania is back 1.2%, so is Northern Territory a little bit, but the other regions are carrying on, especially WA. Now you have to be obviously very careful with WA because there's a lot of mining towns which may be making this data a bit skewed. All right, so it doesn't mean that WA just generally is fantastic to buy. You actually have to do some analysis. But overall, regional areas are doing very well. So them improving in value is not just a COVID phenomenon. It's been a long time since COVID. And I said that during COVID as well, that it's not just because of COVID that regional areas do well. In terms of capital cities, Hobart in the last 3 months is backwards by 1.5%. Melbourne by almost 1%. Sydney's kind of flat, but Brisbane, Adelaide, Perth, charging on. Perth at about 5%. Now that's obviously in the last quarter. You times that by 4 to get an annual figure. You're looking at, if it goes in a linear direction, a 20% increase, in the next 9 months in Perth property market. Now, of course, that may or may not happen, but that's the trajectory we're running, and Adelaide and Brisbane are likely to do very well as well. If you look at that same data on a line graph, you can see very clearly that there was, Adelaide was due for a bit of a downturn, much like Sydney has experienced, Melbourne has experienced. Sydney, Melbourne especially Sydney did quite well last year in 2023, but now is giving up some of those gains. Brisbane and Adelaide have continued to forge ahead. Adelaide a little bit more so than Brisbane. I'm myself quite surprised by this because the affordability story is not that strong in Adelaide anymore, but it may just be a case of, hey, it's one of the cheapest areas for a capital city. So a lot of people are moving there, investing there to make most of those low price points. Now, that may change when interest rates drop or what have you, but that's carrying on for the time being. By the way, I don't think it's a great time to be, in terms of buying window, to be buying in Adelaide just because prices are going up right now. I think, you might be 1 or 2 years far too late, but nonetheless, they continue to go up, but there is a high risk of them correcting a bit like what Melbourne is experiencing now. And you can see in terms of on the right chart, Perth forging ahead as well, seems to be going from strength to strength, whilst Hobart, Darwin, and ACT kind of languish. Darwin it's not really performed that well. It's always been on the verge of doing really well, but then there's some news from a resources sector or LNG sector that's taken the pressure away from the market. Always a higher risk market to be buying. In terms of the sector within each market, within each city that is performing the best or worst, sector meaning is it the lowest priced properties, the priced properties, or the most expensive priced properties. You can see in Sydney, the downturn or the flatlining is really led by the more expensive side of town, those in the 75th percentile and higher in terms of price point. Sometimes people say, oh, good, high income, rich suburbs, they always perform well. It's not the case at all. You can see them giving back a lot of the gains achieved last year. Medium and low is performing still relatively okay in Sydney. In Melbourne, it's the expensive areas that are really retracing, whereas the medium to inexpensive, they are retracing, but not so much. Brisbane, it's the more cheaper end of town that's really seeing the highest gains over the last quarter, and that's quite significant. 4% for the 25th percentile and below properties in Brisbane. That suggests that over a 12-month horizon, that 4 could be 16. All right, so that's quite a significant price rise potentially for Brisbane, lower end of town. Adelaide, it's much the same pattern. Perth has really seen a flight to affordability, and everyone knows that the areas under 700k have really been the ones that have gone up by 30, 40, 50, 60% in the last 2 or 3 years. But now the medium end of town, 50th percentile and 75th percentile are now catching up. You can see far and away the most highest performing city, and as predicted, if you've been watching my videos, Hobart backwards, also somewhat as predicted. I've got Hobart wrong previously. Back in 2015-16, we were very bullish on Tasmania, bought a lot of properties, myself and clients made a lot of money, and I thought it was time around 2020 for it to have a slowdown. It didn't. COVID came along, stimulus boom, and then around 2022, I said, look, now I have to be right. Okay, I was wrong 2 years ago. I have to be right. I has to start shallowing out, and it did start doing that. Although, it did give a good fight, but you can see well and truly now, those gains have been given up as is normal in a medium-term cycle. Darwin, choppy, as I mentioned before. I don't think there's a clear thesis for you to put your blindfold on and say, yep, Darwin's cheap. Well, it is cheap, but it doesn't mean it's cheap. It always goes up afterwards. So it's a bit choppy, hard to make of Darwin, really. There's always maybe 5 or 10 suburbs that are investable, but once again, at a higher risk appetite than perhaps than Perth or Brisbane, other places. And ACT, vacancy is quite high. ACT has performed really, really well, quite top heavy now, and it's time for a bit of a give back. Now let's go through each capital city one by one. Sydney property market in January, it rose by 0.2% over the quarter, 0.1%, and over the last year, 11.4%. So yes, it's had a great 2023, but you can see the recent trend is quite shallow, and I think the constant rising of interest rates has meant that those price gains are probably due to give up a little bit of territory. Melbourne, it's been a very interesting one. I think there's a lot of value in Melbourne because it hasn't grown so much over the last year or two. As you can see, only 3.9% over the last 12 months. But right now is probably not the best time to get into the market, still falling in value. Brisbane, 15% growth last year. It kind of recouped a lot of what it gave away in 2022. In January, it's grown by 1%. Over the last 3 months, it's grown by 3%. I see this kind of trajectory carrying on. Adelaide, like I said before, is still keeping up the good fight. 10% growth in the last year, 1% in the last month, and I think this is going to start to shallow out this year. If it doesn't, then I think we're approaching a bubble territory that could pop in Adelaide. Perth, 16.7% low last year. That's terrific. 5% is the highest of all capital cities in the last 3 months, and 1.6%. Still very affordable. In 2014, the average median on Perth went to about $540,000. Right now, it's about $590,000. So it's not like it's, hundreds of thousands of higher than the last peak. It is at a new record high, but only just. So I think it's got a long way to go. Hobart is falling slightly over the last 12 months. Last 3 months, 1.5% fall, and last 1 month, 0.7% fall. So this, rate of fall isn't really slowing down. Darwin flat over the last 12 months, 0.7% growth. So a little bit of recapture there in price momentum over the last 3 months, and the last month 0.3%, just sort of treading water. Canberra 1.2% growth in the last 12 months. Last quarter 0.2% growth, basically nothing. Last month negative 0.2%. So Canberra is really trying to find its identity right now. The market doesn't know what to make of it, and I think there's a big risk it could continue to fall. Median days on market is sometimes a really interesting leading indicator, and that's why it's reported by all major data sources. And basically it shows how quickly our houses from the point of listing actually selling. Okay, and obviously a lower median days on market suggests that it's really hot market or it's a heating market. Demand is strong, and we can see here that days on market in just a last little while has started to go up a bit. So the lag effects of interest rates are being felt. But once again, there's markets within markets. So if you look at individual cities like Perth down here, January 2024, days on market's just 11%, whereas a year ago, it was 21%. So overall, nationally, days on market's getting weaker. Demand is not really improving. There are some areas, Adelaide, Brisbane, Perth especially, where year-on-year days on market has improved. And I think this is a really key indicator to keep your pulse on to understand future price momentum. Let's have a look at the rental market. What we've seen is that basically since the last 2 or 3 years, the rate at which rents have risen has been a little bit beyond inflation, around this sort of 8%, as you can see, 8-9%. Now it's latest at 8.3%. Now you could look at this and say, look, that's kind of high, like that's not sustainable. Keep in mind that over the last decade, 2011 to about 2020, rents rose at less than the rate of inflation. So they're kind of catching up, and I know it's not pleasant as a renter, but over the long term, these things tend to balance themselves out with the rate of inflation. So I think the rental shortage is here to stay. The housing shortage is here to stay. It's not really getting any better. So as a renter, you're probably good to budget 5 to 10% rental increases depending on where you are for the foreseeable future. Obviously, some areas are more acute, like Perth, rents have risen 13.4%, Melbourne 10%. You can see how divorced sometimes the rental market is from the buying and selling market. Like Melbourne has gone up almost 11% in terms of rents, yet house prices are basically only up 1 or 2% or 3% in the last 12 months. This is an important distinction that investors and owner-occupiers and renters must understand. There's not just one property market. There's the rental market, and then there's the buying and selling market, and then each of them are nuanced depending on where you live, where you want to buy. This is perhaps one of the most important slides in the entire presentation, dwelling approvals. Now, of course, supply is the enemy of growth. The more dwellings are approved, developers say to local councils, I want to build on this kind of land, give me approval, they give it, more houses get built. Therefore, that housing shortage is abated or is softened. Now, if we look at the decade average for houses, just stick with houses for a second, it's kind of up here at around 10,000. All right, but yet right now, or even since the last 1 or 2 years, the average reality is much less than that at about 8,000. So you could say there's a shortage or a difference of about 2,000. And the longer that shortage carries on, the more acute the housing shortage becomes, higher house prices, higher rental price growth. So this is a very important number to keep your eye on as a leading indicator of house prices. Of course, this is all different city to city, town to town, places like Perth, Brisbane, especially up in Moreton Bay, a lot of parts of Perth, parts of especially south side of Adelaide. These are the most acute, as well as regional towns like Toowoomba, like Townsville, like Rocky, parts of Mackay now after 2 years of absorbing a lot of supply. These are really acute areas where the government, the state government, the local councils really need to get their act together. If this carries on, then house prices will just keep going up. It's simple supply and demand. Finance and lending, although not the most sexy of topics, is very important once again as a leading indicator. Generally, when you have more finance approvals, like people going to the bank getting a pre-approval, that's obviously a leading indicator of them going to buy something like an investment or an owner-occupier. You can see just as the COVID boom happened, we saw this huge uptick in finance approvals, and then we sort of saw this come down as that boom finished, the confidence was taken away from the market, and interest rates rose. And now, surprisingly, I think some would say, given the lag effects of interest rate rises are very much here, with unemployment just ticking over 4%, now still 2% less than long-term average, but still it's rising, which is a good thing in terms of softening of inflation. Still, you can see, despite all of those headwinds, the finance approvals and commitments have started to increase over the last number of months. That bodes well for house prices nationally, but it does tend to have a 3 to 9 month sometimes lag in when the price growth actually manifests. And you can see most booms or upward price movements in housing markets are foreshadowed by a spike in finance or lending approvals. Like, look at this in the 2014-15 boom, we saw this right here. And the second chart shows that investors finally have the confidence to come back to long-term averages in terms of their finance activity. Before COVID and sort of since 2017, investors largely left the market. You can see right down here. But maybe that was a normalization of a lot of activity that went up here, causing Sydney to pop, if you remember, back in 2015, 16, etc. Now we're sort of, investors are back to long-term averages, which is actually a good thing, because when investors aren't there, in place of the government building social housing, which they don't, then there is really no affordable or any housing for renters, for those who don't have sufficient deposits or are only temporarily in a dwelling because of work or whatever. So this is good to see that it's rising again. Now, of course, if that goes all the way up to 45, that's bubble territory, so you have to be careful of that. But it's a long way away from that just yet. The areas where you do need to be most cautious, where a bubble territory could be occurring because of too much investor activity versus fundamental long-term decisions made by owner-occupiers, is New South Wales. You can see investor activity is up to 40.7%. Now, that's about 10 or almost 10% higher than long-term average for investor levels versus owner-occupier. So you have to keep an eye on that. If that starts getting up to 45, 50, then you start to think, okay, this price movement in whether it's Sydney or regional New South Wales is unsustainable because it's based on speculation. Whereas in places like Victoria, Queensland's getting a little bit up there, but it's still okay. Tassie's very low. WA is average. SA is average. These other areas are just fine. So just be careful of New South Wales in some areas where it's only because of investors that prices have even grown in the last 12 months. Second to last chart is the RBA cash rate. Everyone knows this, okay? I started investing in 2011, so interest rates were actually higher back then than where they are now. This is saying at the February meeting, the board decided to leave the cash rate unchanged at 4.35%. The board noted progress on inflation, which came in under the November forecast but remains high. Inflation forecasts have been downgraded to reach 3.2% by the end of the year. Now, what's very interesting is our RBA governor said that we don't need to reach within our target band of 2 to 3% inflation for interest rates to start coming down. So if in fact their forecasts are correct and we do reach the low threes by sort of late to end of this year, then we could see 1 or 2 interest rate falls in the end of this year in 2024. But I wouldn't hold my breath. You know, there's always data coming out every month, every quarter. We need to constantly monitor it to make decisions. But I think, I could be wildly wrong, but I think 99.9% of economists, analysts, central governors, central banks, investors, corporations, companies, 99.9% of them think that there's interest rates falls coming rather than rises. Unemployment is rising finally, which is actually a good thing. Seems very sadistic to say that, but we need unemployment to rise because that is a key leading indicator of the heat is going away from the market, the local economy. We really need that to be in the 4.5s, maybe even touching 5 by the end of this year. They're forecasting it to rise to 4.3% by the end of 2024. These things tend to creep up on you. I wouldn't be surprised if it's higher than that by the end of 2024, which only bodes well for the quantitative easing cycle to begin. Now, that's not a scary thing for us investors. It's completely normal for unemployment to be at 5 or 6 or 7%. That's in fact long-term average. The last Sydney boom, unemployment was up at 6%. So we welcome that, although it's not great because of course some people lose jobs. The last chart, thank you for being with me, is a very, very nerdy chart, but I think very interesting. Housing credit. This shows how risky or stable our banking system is and therefore our housing market. Now, of course, at the start, I said that the LVR, or the amount of debt on our national housing value, is less than 20%. And so there's no risk really at all. But this further underpins that point. The percentage of loans on interest-only terms, okay, not paying principal, so a little bit higher risk, has fallen down to 18.2% as of September 2023. The percentage of loans originated with a loan-to-income ratio of more than 6 times, so people are really maxing themselves out to be able to get a property. That was really high in the middle of the COVID boom, 21, right? 22, but now it's all the way down to 2.9%, so that's low risk. The percentage of loans originated with an LVR of higher than 90%, that has come down from a high of 14.1% in 21 to just 6.1%. All right. And of course, investors, that's even further down to 2.3%. They're in the orange. So investors really aren't taking any risks in terms of gearing up too much, nor are owner occupiers. Guys, hopefully that was informative. It gave you value. Remember at the very start, I said, without data, you're just another person with an opinion. There's 25 million property experts in Australia. Hopefully this has given you enough arsenal for you to say, okay, do I want to invest right now? There's clearly some areas that are booming, some areas that are falling. If I do want to invest, where should I invest? And therefore, how should I invest? If you really want to understand the how, I'll leave links below free to my podcast, Oz Property Mastery with PK, on Google, Spotify, iTunes, and also join my Facebook community with 50,000 members, Australian Property Mastery with PK, and you'll really learn where to invest and how to invest. Go ahead and do it, guys. Hit the subscribe button, give it a like. Thank you so much for being with me. My name's PK. Take care.